Good morning, everyone, and welcome to the Morning Bell. I'm Robert, and joining me, as always, are Lizzie and Steve. It's Tuesday, February 3rd, 2026, and we've got quite a bit to unpack today. Markets are showing some interesting dynamics, particularly around tech stocks and precious metals. Lizzie, let's start with what's been moving markets. We saw some significant volatility in both tech and commodities yesterday. What's your take on the main themes we should be watching?
Thanks, Robert. The big story yesterday was really this tale of two markets. On one hand, we had Palantir absolutely crushing earnings and igniting a tech stock rally, with shares jumping over 10%. The company's AI momentum is clearly resonating with investors, and it's providing some much-needed relief after the DeepSeek sell-off we saw earlier. But what's really interesting is the action in precious metals. Gold and silver experienced this dramatic whipsaw, with gold suffering what some are calling its worst day in 46 years, before staging a solid rebound. Silver's been even more volatile, and there's this narrative emerging that it's become something of a death trap for retail traders who piled in during the rally. The contrast here is notable, because while tech is finding its footing through strong fundamentals and earnings, the metals market seems to be driven more by sentiment and positioning than anything else.
That's a solid observation about the divergence between fundamental-driven rallies and sentiment-driven volatility. The precious metals situation is particularly interesting because we've seen such extreme moves in both directions. What do you make of the broader implications for market sentiment? Are we seeing a rotation back into risk assets, or is this just temporary relief?
I think we're in a bit of a transitional phase, honestly. The Palantir earnings beat is significant because it validates the AI investment thesis that's been under pressure since DeepSeek raised questions about capital intensity. When you look at the details, Palantir's showing that there's real revenue generation happening from AI implementations, not just hype. That's what the market needs to see right now. On the flip side, the metals volatility suggests there's still a lot of uncertainty out there. Traders are clearly nervous, and you're seeing that in the options market, where some were betting gold could hit $20,000 during the worst of the sell-off. That's not rational pricing, that's fear. I think what we're likely to see is a continued focus on earnings quality and actual business fundamentals. Companies that can demonstrate real AI monetization, like Palantir, will likely outperform, while speculative plays and momentum trades in commodities could remain choppy. The other interesting piece is Verizon, which posted solid subscriber growth and announced a buyback, but analysts are saying it might be too late to chase that stock. That tells me the market is getting more selective about valuations, even when the news is positive.
That selectivity is an important point, especially as we move deeper into earnings season. Steve, let's turn to the economic calendar. We don't have any major releases today, but what should we be watching for the rest of the week?
That's right, Robert. Today is relatively quiet on the data front, which gives markets a chance to digest yesterday's action. However, we do have the JOLTS report scheduled for release today, with expectations for 7.1 million job openings compared to the previous reading of 7.146 million. This will give us insight into labor demand, which remains a key focus for the Fed. Looking ahead to the rest of the week, tomorrow we'll get the ADP employment report, with forecasts calling for 40,000 private sector jobs added, down slightly from the previous 41,000. This serves as a preview for Friday's main event. Wednesday brings initial jobless claims with expectations for 210,000 claims, essentially flat with last week's 209,000, suggesting the labor market remains stable. Then Friday is the big day, with non-farm payrolls expected to show 70,000 jobs added, up from just 50,000 in the previous month, though that's still a relatively modest gain. We'll also get the Consumer Confidence Index on Friday, with forecasts for 55.8, down slightly from 56.4, which would indicate consumers are becoming a bit more cautious. The employment data is particularly important this week because we've seen some softening in the labor market, and the Fed will be watching closely to see if this trend continues or if we're seeing stabilization.
Thanks, Steve. That employment data will definitely be crucial, especially with the Fed still trying to navigate the path forward on rates. Lizzie, let's shift gears to value investing opportunities. What's caught your attention on the value front?
I've been looking at MPE.L Group, which trades on the London Exchange under the ticker MPE. This is a palm oil plantation company operating in Indonesia and Malaysia, and it's showing some really compelling value characteristics. The stock is trading at a price-to-earnings ratio of just 8.91, which is well below the market average and significantly under Benjamin Graham's conservative threshold of 15. What's even more interesting is the PEG ratio of 0.14, which means you're paying just 14 cents for each unit of growth. That's exceptional value when you consider the company is showing 64% earnings growth, though we should note that's likely driven by cyclical tailwinds in palm oil prices. The return on equity is 20.6%, which is outstanding for an agricultural commodity business and well above Warren Buffett's 15% threshold for quality companies. The company also maintains a fortress balance sheet with a debt-to-equity ratio of just 3.7%, meaning it's essentially debt-free. This provides enormous financial flexibility and protection during commodity price downturns. The profit margin of 28.9% is exceptional for the agriculture sector and suggests genuine operational efficiency, not just price leverage. Now, there are some risks to consider here. The company is exposed to palm oil price volatility, and current margins may be at peak cycle levels. There's also ESG risk, given the palm oil industry's environmental concerns, and geographic concentration in Indonesia and Malaysia brings political and regulatory risks. However, analyst targets suggest about 30% upside potential, and the combination of quality metrics with deep value pricing creates an interesting margin of safety. For investors comfortable with commodity exposure and emerging market risk, this presents a classic value opportunity where you're getting quality business characteristics at a bargain price.
That's a thorough analysis, and I appreciate you highlighting both the opportunities and the risks, particularly around the cyclical nature of commodity prices. The debt-free balance sheet is certainly attractive in this environment. Now, let's talk about our stock of the day. What are you focusing on?
Today I'm looking at UiPath, ticker PATH, which is a leading robotic process automation software company. This stock has had a challenging run, down 21% year to date, and trading at $12.54, which is 37% below its 52-week high of 1984. Let me give you some context on this company. UiPath pioneered the RPA space, helping enterprises automate repetitive, rule-based tasks through software robots. They've built an end-to-end platform with embedded AI, machine learning, and natural language processing capabilities. Over the past year, the stock has declined nearly 12% as the broader software sector faced multiple compression and concerns about enterprise spending. The company hit a low of $9.38 before rebounding to current levels, representing a 34% bounce from the bottom. Now here's what's interesting about the current situation. The stock is trading at a forward price-to-earnings ratio of 16.49, which is quite reasonable for a software infrastructure company, especially when you compare it to the trailing PE of 29.86. That compression from 30 down to 16.5 indicates the market is expecting significant earnings growth and improved profitability. The company is clearly in transition from growth at all costs to profitable growth, which is exactly what investors want to see in this environment. Looking at last year's performance, UiPath faced headwinds from increased competition, both from established players like Microsoft and ServiceNow, and from AI-native startups. Enterprise software spending has been under pressure amid economic uncertainty, and there's been a broader sector rotation away from high multiple growth stocks. However, the company's position as an established RPA leader with strong enterprise relationships and switching costs provides some competitive moat. For the year-to-date period, the 21% decline has been painful, but it's created what could be an attractive entry point. 15 analysts covering the stock have a consensus target price of $16.40, implying 31% upside from current levels. The recommendation is hold, which suggests analysts see value but want to see execution before getting more bullish. Looking forward to year-end, the key question is whether UiPath can demonstrate that its platform is benefiting from the enterprise AI adoption wave. The integration of AI and machine learning into their automation platform should position them well, but they need to show revenue acceleration and margin expansion. I'd estimate a fair value range of $15.50 to $16.40 by year-end, representing 23 to 31% upside. The main risks include intensifying competition, continued macro headwinds on enterprise spending, and the potential for generative AI to disrupt traditional RPA approaches. For current shareholders, I think holding through this transition makes sense, given the upside potential. New investors might consider building positions on any weakness toward the $11 to $12 range, or waiting for quarterly results that demonstrate business momentum.
That's a comprehensive breakdown, and the transition from growth to profitability is definitely a theme we're seeing across the software sector. The 30% upside to analyst targets is significant, though the hold rating suggests some caution is warranted. Let's wrap up with crypto trends. Lizzie, what's happening in the digital asset space?
The crypto market is showing some interesting divergence right now, Robert. Bitcoin is in a mixed position with sentiment hovering between neutral and slightly bullish. We're seeing some positive developments, like the recovery of Bitcoin ETF inflows after that $1.5 billion sell-off, and there's increased institutional interest in Bitcoin borrowing for long-term planning rather than just short-term liquidity. Cathie Wood's ARK bought over $70 million of crypto stocks during the recent slide, which signals some smart money seeing value. Analysts are citing reasons for a potential rebound toward $85,000, and there's this notion that $75,000 might mark Bitcoin's price floor for 2026. However, there are bearish voices too, with Galaxy suggesting Bitcoin could fall to $56,000 as reasons for gains remain hard to find. The key factors to watch are institutional adoption trends, Bitcoin ETF performance, and macroeconomic indicators. On the institutional front, we're seeing some notable developments. Germans can now buy Bitcoin, Ethereum, and Solana products directly from their ING accounts, which is a significant distribution expansion. Tether just released an open-source operating system for Bitcoin mining, which could democratize mining operations. The positioning in Bitcoin looks interesting because we're seeing what Bitwise calls fire sale value due to ETF outflows, but at the same time, ETFs are seeing a cash rush as traders hunt for bargains. Ethereum is facing more bearish pressure, with analysts noting a brutal 21% slump. The lack of leverage and what's being called the gold vortex are cited as reasons for the sell-off. However, some analysts are drawing parallels to previous cycle bottoms, suggesting this stumble could actually mark the start of the next bull run. It's a contrarian view, but worth monitoring. Solana is showing the most bullish characteristics of the three. Parify Capital just made a $35 million investment in Jupiter, a Solana-based project, and the Moscow Exchange is adding SOL futures contracts to its crypto derivatives lineup. This institutional adoption is a positive signal for the Solana ecosystem. For the week ahead, I'd say Bitcoin could trade in a range between 70,000 and 80,000, with a bias toward testing the upper end if ETF inflows continue. Ethereum might remain under pressure in the near term, potentially testing support levels before finding a bottom. Solana has the best setup for upside, potentially moving toward $120 to $130 if the institutional momentum continues. The overall crypto market sentiment is cautious but not panicked, with extreme fear readings suggesting we might be near a local bottom. The key will be whether we see sustained institutional buying or if retail capitulation continues.
Well, that wraps up today's Morning Bell. We've covered a lot of ground from the tech rally led by Palantir to the precious metals volatility, the upcoming employment data, our value pick in MP.L Group, UiPath's transition story, and the diverging crypto trends. As always, remember, do your own research and consult with financial advisors before making investment decisions. Thanks for listening, and we'll see you tomorrow.